We're joined today by Alex Morris, CEO of FM Investments. We'll be talking about his outlook for the economy, the sectors that he likes, the stock market outlooks that he has for us. Welcome to the show, Alex.
David, thanks for having me.
I appreciate it. Thank you for being here. Let's talk. We're talking about your outlook for the market. So we had this rebound following the dip starting in July, basically. And of course, earlier in the month in August, there was a big correction one day on Monday. A lot of those losses have been recovered. Do you think this rebound is going to continue? In other words, this upward momentum that we've seen over the last 2.5 weeks or so, is that going to stay?
I think so. Yeah, I think we should ask what caused the dip. And it wasn't a fundamental change. The stocks didn't change between that Thursday and Monday all that much. There weren't earning reports. There wasn't anything really that happened other than the Bank of Japan said a few things and a big amount of traders got nervous. And this is one of the, very few events that really was a trading and liquidity event. It wasn't a underlying fundamental event. And as a result, now that that's kind of found its way out of the market's going to go back to the same momentum it had before, which was a, upward trajectory, even if that might be to the consternation or chagrin of many Fed governors and handful of others. But there's no reason for that to change. That news is the same as it always was. And now we've got the trading liquidity-based blip out from under the market, and the market's just kind of, if you'd gone away on holiday for a few weeks and turned your phone off, we would never have known that thing ever happened, and that would probably be okay.
Now, Alex, tell us about your outlook for yields. So we have this decline, the 10-year in particular, 4.5 down all the way down to where it currently is now, which is much lower. Is this the start of a renewed bull rally for bonds?
Well, we've always been bond bulls. We always think it's an opportunity in the bond market, right? It's just for a long while that had to be total return. It wasn't income. We think that income part is back. On the U.S. sovereign side of the house, it's clear rates are going to come down. The question is just how much and how fast over the next year. I think Jay Powell is much more of a hawk than most folks are hoping he is. And I don't know why they would have any reason to believe otherwise. He's made pretty clear. We're going to beat inflation and we're going to beat it now. And the Fed doesn't want to have a whipsaw effect of rates went up faster than anyone, faster than Volcker even. And now they're going to come down faster. That's going to be a slow process. That's going to bring yields down. I do think the market might be a little ahead of itself as to how fast, right? If you look at the Fed futures market, which is one of my favorite because it's always wrong. It's one of those few measures that if someone says, I just looked at this, my answer is wrong. I don't need to hear the rest of the question. And it's because it's a wagering market based on what 14 people are going to think in some number of days from now. And that's really hard to do. So we look at that though, and we look at where rates are going in futures. And I think folks they're trying to price in 3 or 4, maybe up to 6, short-term cuts. And I think that the Fed has been pretty clear that this is a 2-ish game. Like it wouldn't be a total shock here in September that they were going to hold rates, if only because they want to get out of the way of the election. But 25 wouldn't surprise me. The jumbo cuts would. And I think you're going to see a very strategic series of cuts just as long as Jay Powell is still in the seat as Fed chair. And that's because they don't want to reverse back on this. They spend a lot of time trying to develop credibility in their messaging. And they're not going to give that up right away.
The relationship between the 10-year and stocks is not always consistent. There's periods where they're inversely correlated. There's periods where they move in tandem. For the last couple of weeks, they've been inversely correlated with the yield coming down and stocks continuing to move up, which usually in a bull market for stocks, it doesn't usually happen because usually they move up in tandem. What do you make of this relationship? Do you think the inverse correlation is here to stay?
Well, so the inverse correlation is the historic one, right? If you were to go back to those charts we get from all sorts of folks, right, and you look for the blue diamonds where you have anti-correlation to the S&P 500 and positive yield, the U.S. Treasury curve is the thing that's there and the only thing that's there reliably. So it's kind of, that's the way we'd expect it. It would make sense if you saw rate cuts happening in a pretty orderly way. Rates are coming down, therefore yield is going to come down on the 10-year, and that stocks will go up because that freer availability of short-term cash will mean investment into large companies. Makes sense. I think that probably sticks around for a little while, and that's just driven by the fact that as rates come down, the 10-year is going to, the short-term rates come down. The hope is that the entirety of the curve comes down. I don't know in 12 months if that's necessarily going to be the case because we're not starting from the traditional yield curve shape. We've got this weird inversion. First it was a pretty steep one, and then it looked a little bit like an S. And you hear camel hump, all sorts of these other analogies that come out to try to explain something we just really haven't seen in a very long time, if ever, in this exact configuration. So I think for the short run, that's going to be true. That there's two things that would stop it. One is that the 10-year just becomes more that the yield just goes up. And that would probably be because rates reverse themselves. Feels unlikely. And it's because the 10-year is so popular. So if you were to look when rates started first going back up, the 10-year sort of stubbornly stayed low. And that wasn't because the 10-year had any special quality other than it is so popular. Folks kept buying the 10-year, keeping yields low, prices high. So I think you're going to see that sort of behavior come back in. When folks are looking for a haven asset, they're going to come to the 10-year. But that said, I think stocks are going to get their pop. We're going to go through a very interesting, contentious election here in the U.S. And then stocks are going to go back to doing whatever they want. If liquidity just comes net out of the market, stocks are going to go down pretty dramatically. And you might see that correlation reverse itself and that stocks go down and yields go down. But it's now because liquidity is driving one of it, not a fundamental analysis of anything else.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. I do want to come back to the election's impact on the markets, but first let's go back to the stock markets for just a minute. I've been hearing several takes on my show, at least, that following a Fed pivot, we could expect a correction in stocks. Historically, what happens is, if you just take a look at the Fed funds rate, after a pivot, an Ember-designated recession has historically followed. Recessions are typically bearish events for stock markets. Therefore, we can make the assumption that this time could possibly be, no different. Is it different this time, Alex?
Yeah, it seems every time is different, right? Even when we say they're the same, and then when they look the same, we say it was the same, but it was a little different, right? So it's easy to be an armchair historian. I think if we look at those events, the Fed usually was cutting rates because there was a recession happening, or so imminently so that we just hadn't declared one yet, but we knew it was there. Just don't know that that's true now. I mean, the NBER isn't talking about declaring a recession. GDP numbers are strong. Growth is still strong, right? If this is a recession, it's the funniest one that we've ever had with positive growth numbers, right? I think a lot of folks are calling for these cuts because they see cracks in the job market, and we had a big job market revision number down, and it really shouldn't be a surprise that these models don't work out as cleanly as we had hoped, right? Many of them just don't work out that way, and we're learning the models aren't as accurate as we would want. Even Jay Powell said about a year ago, all the Fed forecasts were wrong. Most forecasts they're no different. And so we're starting to see that the cracks of the data modeling that had been done. That said, I still don't see that recession coming. I mean, maybe it's hidden away and I can't see it, but GDP doesn't see it either. But we're still hiring a lot of people. The unemployment rate in historical terms isn't frighteningly high in any way, shape, or form. It's still relatively low. So that recession isn't here. We're cutting rates to get in front of a recession not happening, right? Or because the popular demand is rates have been too high for too long, and they will create a bigger problem in the future. And that's the Fed's balancing act. How do they do that? But the Fed is still aware. They see what the S&P 500 is doing. They're not totally asleep in that sense. But that's not their job, is to keep that high. Their job is to keep inflation at that target and unemployment sustainably low and bearably low. But they're not that focused on the S&P 500 right now.
All right. Well, let's talk about the labor market and the employment situation and ultimately the consumer. Are we sure that the job growth is still strong? I'm not even sure anymore after yesterday's revisions. 818,000 jobs revised downwards. This is the biggest downward revision since 2009, I believe. And the BLS reported that the job growth numbers this year during that period early in the year was actually 30% lower than what was initially reported. So what's your interpretation of what happened here?
First and foremost, the interpretation is that you got to remember these are statistics, right? And statistic could be a dirty word in many ways. And they're subject to all sorts of interpretation. Even though Claudia Sahm made clear, like, look, we're looking at the Sahm rule being violated based on unemployment and other growth metrics, right? And that maybe they don't make sense here because they were built on different sets of inputs. And we have a very dynamic labor market at the moment. And I don't think the statistics are capturing that because there's a lot of folks retiring out, folks who had been retired who came back into the market who are now continuing back to being retired out now that their portfolios are wealthy enough they can sustain that, or the value of their house has gone up that they can cash out and live a meaningful lifestyle on the revenue that they will have generated. So I think we've got a lot of dynamic changes happening that just aren't picked up in the measurement of those statistics. But if you ask most small business owners today, how easy is it to get a new employee? The answer is it's still pretty hard. So we may not be growing as rapidly in those jobs, but we certainly don't have a massive unemployment problem. And that's where I would still focus because, right, that's part of the mandate. It's unemployment and it's inflation. It's not job growth. No, that's an interesting statistic, but that isn't where the Fed spends its time. And it's not where I spend a lot of my time. I look more at are folks losing jobs dramatically such that the unemployment number is now becoming a problem? And that's just not true. It's ticked up, but it's not ticked up to scary levels. And then you look at the other side. Is inflation coming down fast enough where the Fed can declare mission accomplished? And the answer there is not yet. So the Fed is probably still willing to inflict some pain till where job growth is neutral or negative before they can actually say, okay, we really don't, we need to do. And the question is, can they stop just short of that before they create a recession? And we're going to find out.
Do we have a tight labor market right now? Is it difficult to fill jobs, which is why perhaps job growth is slow or looks slower?
It certainly feels that way from being in that job market as a firm. It's hard to find people. There's a lot of, folks moving from job to job. A lot of wage growth is still non-zero in that sense. I suspect there are certain elements of the economy where it's a lot easier to find employees, but particularly in the services sector, information sector, the jobs like in finance, those jobs are still pretty hard to fill with highly qualified candidates. I mean, obviously, you can always start reaching down into different pools of individuals, but I don't see most folks out there saying, I'm looking to hire and it's a one-day process because I'm, just rife with choice. It's still tough.
This is a chart showing the delinquency rate on credit card loans and other commercial products. It's currently at 3.25%, which is the highest it's been since 2011. However, if you just take a look back, it's still not as high as what it was in the 90s, 2000s. So by historical levels, hasn't normalized yet, but still much higher now than just before COVID. So is this rising delinquency rate a concern for you, Alex, in the sense that consumers are losing strength, or can you interpret it by looking at historical data and saying, well, it's just not, it hasn't even normalized to where it was 20 years ago?
Well, certainly you'd have to say it hasn't normalized to where it was. You should take a look at that number and say, wow, on average, 4.5% of people, 4.5% of credit cards are delinquent, which is probably a statement of consumerism more so negatively than it is positively. That number ticking up is worrisome. I mean, you notice the curve has started to flatten out a little bit, which is good. I don't know that we're looking for that number to get anywhere. We're not looking for that to go up, but I do think it is a statement of availability of credit, people's willingness to use it. And if you were to sort of look at what happened just post-COVID, those rates got really, really low and folks had a lot of savings. And so if you have to kind of average that pandemic window to where we are, and probably still do that for the next year or so, and say, look at 2020 to 2028 as a package deal, because a lot of folks got a lot of money in their mailbox they never expected in 2020 and 2021, and a lot of businesses did as well. And that has maybe fully come out of coffers today, but the impact of that hasn't fully been recognized yet. Like we're not yet in a fully normalized environment as a result of it.
Do you see the consumer still able to carry their usual demands and spending patterns well into 2025, or do you see a slowdown in spending following a Fed pivot for whatever reason?
Well, certainly the data shows that luxury spending and spending at the super high end has come down, right? But that people still want to spend, so they're willing to compromise on quality or taste, but not on spending yet. And you see that in the Chipotle numbers, right? Folks are willing to come down to Chipotle from a sit-down restaurant, but they're still wanting to spend. They're not yet willing to go to the supermarket and buy all your groceries for a week on a budget and eat your leftovers. So I think the patterns will change. We've seen this before though, where higher end spending and, true, luxury comes out and goes more towards the core. And I think we're going to see that for a little while, but I don't think the population, particularly the U.S. consumer, is ready to stop being a mass consumer. We're just going to see them reallocate those dollars to different places and try to stretch them a little bit. But I don't think we're looking at, some of the stretching that you saw in like 2008, 2009, where it was in, recession and jobs were harder to come by. I think that belief that someone who's employed today can reasonably be employed tomorrow is going to keep them spending somewhere and somehow.
I guess let's just get down to the R word. Are we heading for a recession next year?
I'm going to say no. We're heading for, but probably avoid. Right? We've heard of hard landing, soft landing, no landing. I don't know how that works unless
What do you
go to
mean heading for, but we'll avoid? So we're that's interesting.
So I think that the metric, right, when we look for a recession, we're looking for a certain number of GDP, numbers over a sustained period of time. And I think we're going to see those numbers get close to that, but GDP is still strong, right? So we're not like at the spot where we're going to see, negative growth and contraction for a period of time. A lot would have to change between now and the end of the quarter for that to happen. But I do think we're going to see those numbers get tighter. So folks who have been, screaming for and ringing the alarm bells are going to have a lot more to actually sink their teeth into next year. But I think the Fed is going to keep rates stubbornly high, that they will have what they didn't have last time around, right? If we go kind of wind the clock back about 12 years, we're complaining that the Fed hadn't raised rates high enough so they couldn't lower them fast enough to avoid a recession. I think now they have that. They have rates high enough that they can lower them, and they can lower them quickly enough to restart the economy when need be. And I think that's what they've been holding on to. They sort of learned the lesson from last time around, where when rates only went up to 1%, you couldn't drop them 2% to restart the economy. But when they're at 5.25% and you only drop to 4.5%, you've got enough in the tank that if something starts to go wrong, you can offer the market still a 50 basis point cut and really restart the economy and sort of restart that energy faster, and much faster than I think folks would expect.
Okay. Do you think the Fed pivoting, cutting rates would change consumer spending patterns at all?
I think the first 25 or 50, not at all. Most folks won't notice it, right? It'll be news for a lot of financial people, but the average consumer isn't going to really know and feel what that means. I think when you start to see that, really start to normalize, and we're going to figure out where that new normal is. Is it 3.75? Is it 3.5? Is it 3? Right? Where do we fall on short-term rates? That's when it will really start to happen. The question is, though, if that does create a massive run in the stock market or makes it available, makes more credit available to people, are they going to feel it at all? Is the question, and maybe not yet. But I don't think that short run they're going to feel it. I think if that's going to issue, that's going to be a 2026 early issue, not a 2025 immediate issue in any way, shape, or form.
So going back to stock markets now, any particular sectors that you favor over others?
The banking sector has been beat up a little bit, and we still always kind of like that space. Consumer products still seems to be a pretty good space to be. That said, we do think defense, there's a lot of cold and hot wars going on. That's got something to say for itself. And if we're wrong about all of this, that's probably a good place to be. We tend to stay away from home builders and REITs and some of these other metrics, just because they tend to have a lot of other things moving on. If you looked across our book, we're not heavy into biotech or some of those other items. We do have a lot of consumer services, a lot of communication services as well. But for as much as no one wants to say that NVIDIA drove a big chunk of their returns, it's pretty clear it drove a lot of returns for a lot of people, particularly if you were just in a passive index. So, we're cautious in how we shop there. of the Mag 7, 6 of them really paid off, and we were in those 6. We're not afraid to hold on to some of those, right? If we didn't hold on to some of it, our beta would be so far off that it would be hard to buy into those products. But yeah, we think those are going to continue to do well. And if you think we're wrong on all of it, we've been big fans of Warren Buffett's T-bill and chill. And as you and I are talking about, we run TBIL. So it's a great place to hang out. And while you try to figure this out, still clip a 5% coupon and work out where you should be.
I actually had a guest on earlier the week point out that the T-bill ETF was a good way to hedge against volatility when everything's moving up and down. This just goes sideways. It's collecting steady coupons at every fixed interval. So yeah, it is a good way to protect wealth. So to speak. But I want to come back to your products towards the end of the interview. How would you play the yield curve steepening? It's been steepening for quite a while now, 10-year minus 2-year. First of all, assuming this trend's going to continue, I don't know if it will, but I'll let you answer that. But assuming it does, how would you play it?
Yeah, so we've been encouraging folks who don't want to sit on the short end and just kind of wait it out and see what happens to short-term rates to really start extending duration. Whether it's something like the 2-year, the 10-year, we offer products for both U2 and U10. We see a lot of action there. The 5-year tends to be a pretty good place to be. Right, 5-year underpins a lot of car loans and has a lot of other reasons to be bought. So it has high liquidity. And that's been a pretty good place to balance duration. But we do think folks should be extending duration. And we think, though, in particular, if you're going to play the bond market and the yield curve like that, you do need to stay on the run. The liquidity of those issues are really important, and it does mean more trading unless you buy into our products, where we'll do that for you. But that becomes way more important because folks are like, oh, well, I played this part on the curve, and well, sure, but you bought a 2-year bond. It's now an 18-month bond. It doesn't behave like your 2-year, and there's not a lot of market for an 18-month bond. There's a market for a 1-year or a 2-year. So you're kind of on the wrong side of that bill or note divide. And we think that makes a lot of sense. But we're encouraging folks to do that. We did see the 2s and 10s uninvert for about 3 minutes one day, and they kept fighting with that neutrality. But I do think as you see the Fed start to make its move, you will see some normalization in that space. The 10-year, the problem with the 10 years, it kind of defies a little bit of logic. As we said earlier, it's so popular, has so much demand that its yield almost stays low. And if you looked at the 10, 20, and 30-year, you kind of see that happening, right? The 20-year is structurally cheap. The 10-year tends to be structurally expensive because it has such high demand. And the 30-year kind of, is where you'd expect that extrapolation to be, splitting the difference between the two. And that I think that's going to continue.
We've talked about the upside for a lot of the assets that we discussed so far. What about risks? What are the major risks facing investors of any asset class today?
I think a lot of the markets have become very liquidity driven, and folks look at volumes as liquidity, and volumes are a measure of things changing hands, right? The actual liquidity, though, may be much lower than we think. And a lot of that was because of the yen carry trade. Like everyone got a first class lesson in what's the difference between volume and actual available liquidity and who's controlling it. So we think it's really important for folks to not venture too far off the beaten path of things that you can move in and out of quickly and at a fair price. And that's the difference, right? Is that we think that it's good to stay liquid and not just things with high volume, things that have actual natural flow behind it, where you can move in and out at fair value. I think that's the big issue is if there are some pretty substantial changes in allocations, folks might find themselves caught out when the thing they thought was highly liquid now has 90% of the liquidity behind it. You just left that sector and went somewhere else. And I think that's going to be the thing that surprises people is when these moves happen, how quickly you're going to have to follow suit to actually enjoy that first bit of pop or, the majority of the upside. So I think a lot of that's going to happen pretty fast and much faster than 10, 15 years ago when that started to, when we first really saw post large Fed intervention moves happening.
Looking ahead now, medium to longer term, the major themes of investments that you as a fund manager would watch. For example, a couple of years ago, 2021, inflation was peaking around 9%. So high inflation was a theme. Before then, risk management in the wake of a black swan like COVID was a theme. All throughout the 2000s, I remember the rise of China and base metals and commodities was a theme. What's next?
I worry a little bit about commodities. I think a lot of folks, overlook them. But some things are pretty cheap today. Don't know how long that's going to be true. And I think that relationship between inflation and commodities is going to be something we talk a lot more about in the next few years. It flares up every now and again when we talk about lithium and maybe control over certain markets. Certainly, the nickel crisis 2 years ago proved that maybe some of those can get in over their heads. But I do think we're due for a cycle where commodities are going to be an important part of it, and that relationship between inflation and commodities is going to be back in the news a lot. Also, the bond market for the first time is interesting again, right? It's always been interesting to those of us trading it, but it's no longer just a total return market. There now you can pick and choose and find some current income, which is really important. And I think we've undervalued the income part of fixed income trades for a long while. And I think if you're particularly looking at retirement or looking at changing where you derive revenue from your portfolio, right? Used to all just be clipping coupons of dividends as best you could, or just selling some big names and trimming them when they got a little too far over their skis. That's really going to come back into the fore. In particular, as we talk about labor market changes, as more folks retire out, having the ability to look at reliable income streams from bonds is going to come to the fore again. And I think my hope is, if only because there's only so much you can say about 7 names going up, and us all scratching our heads wondering how much higher can they go. That those items that we can spend a lot more time analyzing will start to become the focus of the markets.
And finally, election results and the markets. Can you see any significant differences in market reactions to either a Kamala Harris or a Donald Trump win? We could talk about their fiscal plans and their tax plans.
So I think the first thing is very few people thought Kamala Harris was electable till 4 weeks ago, right? So what a difference a month makes, where all of a sudden now it's an opportunity, folks are there. But as a result of it, very few people really knew what she stood for, what her economic plans would look like, what her tax plans would look like, what her foreign policy would look like. So we're all kind of struggling to work out what does she really stand for. We see little shimmers of it now. Well, maybe we'll bring up corporate tax rates to 28%. That feels like it's going to be really, really hard to do. A lot of businesses, a lot of banks are going to be against that. I know Tim Waltz has, previously talked about a financial transaction tax, the idea of let's just tax every trade a little bit. That I think is dead on arrival, and he hasn't talked about it in a long time. But we haven't really seen or heard that plan yet. I think we're going to get a lot of that tonight at the DNC in her speech. I think we've seen elements of it previewed in some of the other speakers, but when she comes out and accepts the nomination and is formally given it, she will tell us a bit about where she thinks it's going to go. We're going to get a debate with Donald Trump, where a lot of that will be hopefully on display and not just talking about handicaps and casting aspersions at each other. But it'll be interesting. I don't think the stock market, though, much cares who wins. It's more worried about the volatility implied from not knowing the winner and not seeing an obvious path forward. And thus far, given we're back up at all-time highs, give or take 50 basis points, I don't know that the stock market is telling us that it's really worried. We kind of know what policies Donald Trump had. Let's not forget the night Donald Trump was elected, stocks were down 8% overnight and finished the next day up 3%. So, stocks will tell you exactly what they think up until they tell you the exact opposite. And I think that's probably what we're going to see. But, and there's been a lot of charts going around. You can choose your favorite of, coloring it red and blue. Turns out that the stock market just kind of wants to go up regardless of whether you're a D or an R or an I or something else in the White House. And I live here in DC. And it turns out government is the one business that just keeps getting bigger. There are more people living here every year, and housing prices keep going up. So I think the market right now just wants there to be a winner. I think the thing that would undo all of this would be if there was a contested election, or if there's a lack of faith in how we got there. And so far, no real signs of that happening.
And finally, tell us a little about the products that your firm offers. I know we touched on T-bill and a few others. Tell us about some. I know you have a lot, right?
Yeah, so we got a lot of things going on here. We've always tried to focus on helping alpha generators find their way to asset owners and give them a platform to do that. We run the U.S. Benchmark Series. I need to talk to your last guest and send them a fruit basket for TBIL. But we run the U.S. benchmark series, which is the on the run U.S. Treasury curve. So TBIL, O bill, X bill, U2, all the way through U10, U20, U30. The idea being you should pick where you want on the curve and make that ETF easy and accessible, which we do. We do the same thing in the credit space for 2, 3, and 10 years, Z2, Z-Tray, Z10. We offer an actively managed fixed income product called XFix if you want us to choose that risk for you and generate some income opportunistically. So we look after that. We also have a pretty developed equity book in the large cap core, and small cap growth space. And a large cap growth fund we trade as IFLX as a mutual fund. And the idea is pretty simple. We're alpha generators. We're looking to take the right amount of active strategies, deliver them to your portfolio. And then in the case of like the benchmark and the credit series, passive products that are really designed for you to decide how active you want that portfolio to be.
Okay. Thank you very much, Alex. I appreciate your time. We'll speak again soon.
David, I appreciate it. Thank you.
Thank you for watching. Don't forget to like and subscribe.